Hi, everyone. This is M. Glad. Welcome to another episode of REIT Ball. Thank you for joining us. Today, we are grateful to have Tim Savage on with us. Tim is an economist, and considering the environment that we're currently in, we figured it was perfect timing to have him on the show today. So Tim is a professor at NYU, and he teaches data analytics and real estate finance. He's also the program coordinator for data analytics and the faculty director of the CREFC Center of Real Estate Finance. In the past, Tim was a former senior managing economist and principal data scientist at CBRE Econometrics Advisors. His nearly 20 years of experience at international consulting firms. His commentary has appeared in publications like The Economist, Globe Street, Wall Street Journal, and now a pretty cool real estate show called REIT Ball, shameless plug. Tim is a distinguished fellow at the NAIOP Research Foundation, where he provides industrial and office demand forecasting. He holds a PhD in economics from the University of North Carolina at Chapel Hill. I'm thrilled to have him on to discuss the economy and a lot of other things throughout the show. So without further ado, we're going to bring on Tim to the show. Hey, Tim, how are you?
I'm doing really well. How are you?
Doing well. Thanks for joining us today. We're excited to talk about job creation, supply and demand, economic recovery, machine learning, and more. So we have a packed show. But first, I think it's important for the audience. A lot of them are newer investors or new to real estate, trying to figure out how to transition. So a good piece that we'd like to include is about their careers as well. Mm-hmm. So if you could just include like how you got to where you are today to become, a thought leader in the industry, a leading economist as well as a professor, and also like you have, what's the future for Tim Savage, right? Like, so what are your future professional goals considering what you've already accomplished?
Yeah, so I, by training, am an econometrician, which is just the application of statistical methods in economics. I like to joke that I'm basically a computer scientist who plays an economist on TV. I wrote a dissertation, oddly enough, entitled The Long-Term Effects of Youth Unemployment, which looked at the potential long-term implications of experiencing a shock early in the work life. And I like to say I brought a howitzer to a knife fight. Very sophisticated algorithm, a quality data set that still exists, and didn't find much in terms of long-term effects. If you want to think about it in the following way, suppose you are not a college-educated individual, but you experience a 6-month unexpected unemployment spell when you're 20 years old. Does that have adverse implications for you for your work life going forward? Are there long-term adverse wage impacts? Does it increase the likelihood of future unemployment, and does it extend a spell of unemployment in the future? And I'm built a sort of toy economic model around the whole thing, where essentially agents or individuals could compensate for these unexpected spells by getting more schooling or more training. And the results essentially showed that individuals do engage in what I called a rational catch-up effort. They get more schooling, they get more training. There aren't long-lived adverse wage implications from shocks earlier in the work life. And then, having finished that, I went on to begin my consulting career at Charles River Associates, a large consulting firm, and did a lot of very interesting things there. We did arguably the first merger to monopoly by arguing that there were going to be no risks to pricing if XM and Sirius merged, which has proven to be the case. I did a lot of work around what we now call the LIBOR price fixing scandal, looking at the performance of the London interbank offered rate, a really important benchmark for the industry during and just after the global financial crisis. Did very well at these consulting engagements. Didn't know a lot about real estate and was contacted by a recruiter who said, hey, do you want to take over this thing called CBRE Econometric Advisors? And I thought, what's that? What's CBRE?
Right.
And
very quickly for the folks listening, CBRE is one of the largest real estate firms in the world, but it proves that you don't necessarily have to be connected to real estate to get your foot in the door.
Correct. And I say that, what's CBRE? I say that as a New Yorker, always passionate about real estate, but not thinking about it from a brokerage standpoint or an investment standpoint. It's just, back in those days, it was just walking by a building under construction and thinking, oh, that's going to be a really cool building when it's done, but not necessarily thinking about the process. Took over CBRE EA, as we call it, which was the former Torto Wheaton research group. Anyone who studied real estate economics knows Ray Torto's name, certainly. Or if you've studied the DePasquale and Wheaton model, that comes from Bill Wheaton. Did that for a while. It, crossed it off my bucket list. And the opportunity, I had been doing some adjunct work at the Tandon School of Engineering at NYU, trying to build out a sort of applied data science curriculum. And when the opportunity arose to come back to NYU full time, I thought, yeah, this is a great opportunity. And I returned, sort of launched the data analytics class with Mark in the class, one of the intrepid six, unknown professor, willing to sit through 250 years of statistics in a week. And
but it was like crash course to make you start thinking about real estate very differently.
Right. And weaving in ideas from finance and economics and data analytics, because as an economist, I don't really see these things as being distinct elements. It's sort of the same thing for me, which is to start with a bit of theory, derive the implications from theory, go look for some data, and use algorithms to examine conjectures about how the world works. And it's all the same thing for me. And for a little while, I was running Shaq's Hirsch Fellows Program, which was an honors program, an endowment gift from David Hirsch, who was recently with Blackstone, headed asset management in Blackstone, retired, generously donated money to Shaq to launch this honors program. And then Shaq won a competitive grant against peer institutions, MIT, Wharton, Wisconsin,
wow,
to launch a center focused on commercial real estate finance. And as I say, places are not the elements of my bucket list. Things are elements of my bucket list. And so when I was approached by Shaq's dean with the suggestion that I might take over the CREFC Center or help launch it, I said, that sounds like fun too. So my arc into real estate is long. Once you recognize the as an economist, once you recognize the slightly strange words like absorption, which really just means demand, or cap rates, which really just means yields, I was on a completely comfortable landscape from my perspective. So real estate is an incredibly interesting investment prospect because of, as I teach in the finance class, because of the differentiation in the assets themselves. The assets are fixed in location, the risks are local and global, and the capital now is global. So when you think about the idea of investing in commercial real estate from an economics perspective, you really want to think about all of the various risks that an investor faces, because it's not like buying a 10-year US Treasury, which is completely undifferentiated from any other US Treasury. It's not like buying Apple stock, which is completely undifferentiated from Apple stock. Location is critical, and thinking about location as a risk factor is really important.
No, and that's part of what we were discussing before kicking off the show, right? With this pilot that we haven't announced yet, but it's pretty much a debt platform, and really getting hyper local and understanding your risk in each, not just each market, but each sub-market as well. So, a lot of that you're able to do in the work, the work that you do in the research. Folks are allowed to take that information and then decide how it can be applied to their neighborhood, to their local market, to really understand the opportunities as well as the risk in that particular market. So thank you for that kind of bio and then the career background. We do have Spurlock kind of in and out for the folks listening. He has a little technical difficulties, but he keeps popping up and leaving. I'm not sure if he wants to be here.
Good to meet you.
Yeah, so welcome back.
Sir. Sorry about that. I had to go to Plan D, so I'm just gonna sit here and hold my phone for an hour, and let's do it.
So it's up to you. We're on. We talked about background. We're on the economic outlook. So you rejoined at the perfect time.
Oh yeah. So I'm happy to jump ahead on the economic outlook.
Yeah. So we were just wondering for the folks out there, so obviously, we know what's going on with COVID. We understand that we had a lot of pain kind of when this first hit us. Then it was odd because you had all this unemployment, but you had a rebounding stock market, a lot of confusion. How much was, when thinking about employment, how much of it was rehired talent versus new employment? So a lot of mixed signals, especially for folks who aren't in this day to day. So if you could just talk about just the impact, if we go back to when we found out, hey, this is a real thing, a global pandemic, how our economy was initially impacted, how real our recovery has been since, and then, what do the next 12 to 24 months look like?
Yeah, so let me take us back a little bit further than COVID. Let me take us back to August of 2019. An important measure that we use to assess the performance of the US economy is what we call the yield curve. It's the difference between the 10-year US Treasury and the 3-month Treasury, the difference between a long-term, long-dated Treasury and a short-dated Treasury. And that had turned negative in August of 2019, which was not a good sign to begin with. In the fall of 2019, the Federal Reserve was already intervening in overnight lending markets. There were dislocation in what Tim Geithner called shadow banking, which are these overnight lending markets where large banks either borrow or lend based on where their balance sheet sits at the end of the day. And there had been some dysfunction in those markets, and the Fed began intervening in the fall of 2019 by essentially expanding its balance sheet, essentially providing demand for these overnight lending markets. This is pre-COVID. This is before the word COVID was on anybody's mind. The signal from bond markets in terms of a negative yield curve was signaling that the U.S. economy was not on solid footing going that far back. Terrific research from Duke Professor Campbell Harvey using machine learning showed that the yield curve was a very strong predictor of economic performance in roughly 18 months. Yield curve goes negative today. The likelihood that there is an economic recession in 18 months or within 18 months is very, very high. So we had that signal, and then we had the signal of dislocation in markets that were the origin of the global financial crisis of 2007 to 2009. I say that because that's a necessary preamble to thinking about the impact of COVID, because COVID accelerated some of the poor signals we had about the U.S. economy going into 2020.
So essentially, you're saying we were already kind of leading toward distressed economy prior to COVID. COVID just maybe accelerated it, or made it worse.
Right. It accelerated the recession and deepened its depth.
Yeah.
Right. And we saw really strong reaction in equity markets that sold off by about a third during the COVID period. If you look at a broad index like the Wilshire 5000, we saw unprecedented terminations. So, which we measure using the first-time unemployment insurance claims. They jumped to a weekly measure. In 1 week, 7 million people filed for first-time unemployment insurance claims in early March. Each week during March showed millions of people filing for first-time unemployment insurance claims. To give you some context, during the global financial crisis, the worst week we saw during the global financial crisis had about 800,000 people filing for first-time claims. So it's an order of magnitude larger during COVID. So you have equity markets that are reacting very rapidly, and you have labor markets that are reacting very rapidly. We then get the traditional monetary policy stimulus and fiscal policy stimulus that were correct policies to do at the time. The Fed lowered policy rates, the overnight lending rate, to zero, and flooded the market with liquidity by expanding its balance sheet to over $7 trillion. That's with a T. In less than a month. And through things like the Paycheck Protection Plan, fiscal stimulus, roughly $3 trillion of potential commitments from the federal government, which I think helped equity markets to recover because it provided liquidity and demonstrated that despite the political rancor in the country, we do actually have the capacity to do policy. Labor markets are recovering slowly. First-time claims for unemployment insurance remain elevated. They remain at about 700,000 per person. I'm sorry, 7,000 people per week, which is certainly elevated. Based on a historical perspective, the unemployment rate remains elevated, and something that I pay a lot of attention to is labor force participation rates, so you can think about the unemployment rate is simply calculated as the number of people who are unemployed as a share of those people who are either employed or looking for work. Labor force participation is the people who are employed or looking for work as a share of the overall population. So it's a measure of individuals' willingness essentially to look for a job. And we're seeing labor force participation rates hovering around 62% currently, which is lower than we saw in the 1970s, or consistent with what we saw in the 1970s as women were entering the workforce.
Now, very quickly, the participation rate, was that impacted at all by the stimulus checks? A lot of folks were getting paid more with the stimulus checks than they were just working full time, right?
So and certainly I think the labor force participation rate was impacted by the stimulus checks. It was also impacted by the need for one parent to stay home with students who were learning online. So both of those things had an impact. But there are no sufficient statistics in macroeconomics. There's no one measure you can go to and say that's it. But I pay attention to the yield curve and I pay attention to the labor force participation rate. The yield curve remains flat. It's roughly 80 basis points today. Historically, it's been, so that's the 10-year minus, so long minus short, 10-year minus 3 month. It sits at about 80 basis points today. Its long-term average over, say, 30 years is 200 basis points.
Oh.
So it remains flat.
Yeah.
And the labor force participation rate declined fairly rapidly starting in March, and it remains at about 62%, which is consistent with numbers that we saw in the 1970s as women began to enter the labor force in large numbers. So that's so what would I summarize in 3 bullet points of those, of all of that? The US economy was not on sound footing going into this. COVID deepened the trough and probably accelerated its occurrence. And the labor market is recovering very slowly. And I worry a lot about how it may exacerbate income inequality and things like that, because at least initially, employees who were affected were low-wage workers, restaurant waiters, things like that. But when I think about where the next 24 months takes us, I remain focused on these phase 3 trials, these large-scale trials for a potential COVID-19 vaccine. When a vaccine goes through stages, the last stage is the large stage trial to show that it has some positive impact, which they call efficacy, and ideally has no long-term adverse impact among a very large group of people. And at the moment, I believe in the US, we have about 5 potential vaccines in stage 3 testing. When I focus on the next 24 months, that is what I'm focused on, is the results from those trials.
So does the clock not start ticking as far as true economic recovery, sustainable economic recovery, until we truly have a vaccine that could be distributed to the masses, in your opinion?
Yeah, I think the US economy, if you think about the rest of the year, by the time December 31 2020 occurs, the US economy will be about a 3% smaller or lower than it was a year earlier. So we are in a recession. When I do forecasting for NAIOP, my forecast for 2021 is positive growth with very low inflation, but conditional on having an efficacious vaccine in the next 6 to 9 months. And we forecast office absorption will be down a bit. That forecast will come out in a couple weeks. We did forecast industrial absorption demand would be negative in the third quarter. When we did it 6 months ago, we were wrong. We were wrong because of the agent that is the most disruptive agent in commercial real estate today, which is Amazon. It appears, it appears Amazon is really moving into signing long-term industrial leases at the moment near urban clusters. In New York, lots of activity in the Bronx. Recognizing, when I think about commercial real estate, that it too is faced with technological disruption prior to COVID. And e-commerce certainly is an element of that. And I think Amazon is moving strategically at the moment, recognizing that COVID may accelerate the growth rate, so the second derivative of e-commerce sales, as we become more comfortable ordering more things through e-commerce or via e-commerce and figuring out the distribution chain that needs to be constructed in order to get those deliveries rapidly. And that's to the benefit of industrial, to the detriment of traditional brick and mortar retail.
No, and I think that's a great transition into kind of the supply and demand of space, right? So in our discussions, you teach a lot about the 4-quadrant model. And for the folks who are listening who are unfamiliar, supply, demand, these economic cycles, it would have been fascinating to learn the 4-quadrant model during COVID and how that changes the 4-quadrant model, right? Because no one expected this, right? So without, intimidating the audience, just really continuing down the path of the COVID disruption, how did it change supply and demand and real estate valuations short and long term, in your opinion? And I know you talked a little bit about industrial, but who are the winners as far as the real estate assets, in the next 3 to 5 years, and who are the losers? Is it still retail? Is it, what are your thoughts?
Traditional brick and mortar retail will continue to be a large loser. We'll continue to see price discovery in terms of rents capitulating along Fifth Avenue, along high streets over the next 24 months. Industrial will continue, I think, to outperform as an asset class in the industry. I think Class A multifamily will begin to see a fair amount of capitulation on pricing. Much less clear what goes on in Class B multifamily. There is the potential that could see outsized growth, again, relative to other asset classes, but that could see outsized growth. And in office, I think it matters a great deal how much retail space a large office building had. Take, for example, Hudson Yards on the western part of Manhattan. They had a number of high-end retail tenants, Neiman Marcus. I think those things are gone permanently.
Interesting.
And adapting that space is critical. To be honest, if I were doing interesting consulting at the moment, I would be focused on retail and roughly what we call Class B multifamily, because I think those are the two interesting areas from an investor's perspective to consider the possibility of an outsized return given the risk.
Thank you for that free advice, sir. we're in the multifamily space. Thank you for that. Please don't send an invoice.
Definitely.
No, fortunately, I do believe that. Industrial will, the outsized performance in industrial, I think, will continue. They need to figure out the distribution model. They need to figure out how they can lower the volume of returns, because the rate of returns to the amount of stuff people return when they buy it through Amazon is much, much higher than when they buy it through brick and mortar, and that makes it a more complicated logistics problem. A large brokerage company that I may or may not know claims, in fact, when large retailers shut down space, they actually lose both brick and mortar sales and their e-commerce sales. So they're claiming they're much more connected than what I might believe, which is they're perfect substitutes. Because I've argued that retail is just a distribution mechanism, right? It's to get goods from a producer to a final consumer. How that happens has changed since the Sears Roebuck catalog was introduced 100 years ago, and with and arguably Amazon's just a digital reboot of that idea in a country that was over retailed to begin with, and that will drive a lot of industrial demand as they figure out how to recognize power laws in terms of urbanization and say, okay, we have to sort of shrink, we need a very large fulfillment center 5 miles out. We need half size 1 mile out, and then maybe some former retail space a block out. And that's a sort of power law. And that's going to take money and time, but it will drive outsized performance. It may help on the office front as folks think about repositioning former retail assets as localized fulfillment centers. And I think that could be an interesting investment thesis if you can obtain scale. I've talked to a number of professionals about this in the industry, and I talk about this and they say, great idea, we can't get scale on it. And that's a challenge. As I say, on the multifamily side, we built a lot of Class A space, the amenity wars. When I was in Boston, my building had an outdoor pool in Boston that could stay open for 3 months a year.
That makes no sense.
You think about the dedication of space to something like that in the amenity wars. So Class A, I think, is going to have a lot of, how shall I say it, a lot of price discovery going on over the next couple of years. Which, again, that's my point, which makes the Class B a more interesting play from an investment point of view. If you've got a large portfolio of Class A multifamily in Boston and New York and San Francisco, I would argue you're going to have a difficult time talking to your investors over the next 2 years.
Interesting. Very interesting. I think both probably rents as well as vacancy, right? Because folks who can go to still a nice Class B, save a little bit of money,
Right.
May choose to, downsize a bit and go to a Class B and still be okay. Because to your point, may not even need all the amenities, and it may make more sense for them to save money per month in the same part of town.
And the need for short-term de-densification of space, right? Until there is a widely available efficacious vaccine, short-term de-densification is critical. Because if you want to, historically, when we think about what were the mechanisms that created recessions, we think about them as either being supply side shocks or demand side shocks, right? So Great Depression effectively turned out to be a demand side shock. We had no insurance for people who had savings at a bank, and It's a Wonderful Life. We know this scene. Your money isn't here, it's in so-and-so's house, or it was used to build so-and-so's house. That was essentially a demand side shock. The bank went bankrupt, which means your savings disappeared, and there was no insurance policy in place at the time. Demand side shock. You think about the recessions of the 1970s, the oil, driven by oil shocks, those were supply side shocks. Oil was an important input to much economic activity at the time. Its price spiked, supply side shock. We face both at the moment. The initial is COVID is a natural disaster that affects human capital, but not physical capital. And it amounts to being both a demand and a supply side shock. And we don't have a lot of good economics on how to think about this. And we certainly don't have a lot of data to think about this.
No, definitely. I mean, phenomenal case study moving forward after we get out of this. And
right.
It's easy to talk about kind of historical economic cycles that just happen, right? And you can try your best to use indicators to predict them and things like that. But this will be a great case study. Not that you can ever predict it, but maybe how you can respond to it better next time in real estate. When thinking about the economy, when thinking about the broader markets, like what we would do differently next time if we were ever shocked with this kind of, or something similar, this type of disruption. So I'll let Kent hop into future use of space. Yeah. I know you've covered some of it with retail, but if there are any additional ideas you have to his question, please feel free.
Yeah, definitely. We continue to hear how COVID has accelerated digital transformation. Considering our current work, live, and play environment during the pandemic, do you think real estate owners need to reassess their use of space moving forward, or do we return to life and business as usual once we return to more of what we used to know prior to the pandemic?
I think the pandemic accelerates e-commerce, so there's no going back in the traditional live, work, play structure, where the play component was some mix of retail and restaurants. I think I don't, long term, I don't think it affects urbanization or dense urban clusters because of something we call the economics of agglomeration, the efficiencies that arise from density. It may change where those densities live. I mean, we know that demographically, Americans have tended to move south and west over the past 40 years. So the next New York may be Miami. We do not, in the long term, lose the benefits of agglomeration. We just potentially move these dense urban clusters from New York to a place like Miami.
So not Mississippi.
No.
I was betting on Mississippi.
Not close enough to the water. Humans like to live near water for some crazy reason. So I think it accelerates long-term implications of COVID. It accelerates e-commerce because we have become accustomed to ordering things online. They get delivered rapidly. Brick and mortar retail doesn't need to play the role it did in the past. Office space, once we have an efficacious and widely available vaccine, I think we don't lose the density that has been developed in office space. But again, pre-COVID, we were already faced with, or we were already considering co-working, which is just short-term leasing. And I think, setting aside what happened at WeWork, there is value to both a tenant and a landlord to short-term leases. It allows a landlord to adjust rents more rapidly in a growing market. It allows a tenant to have the value, the option value. I mean, this is options pricing. The option value of expanding space or contracting space rapidly without the construct of a 10-year lease. At that point, the market functions when the landlord and the tenant share the benefits. I've been very pleased to hear, again, anecdotally, in the market, that commercial real estate, the entire stack, has said, we want to figure out how to share the current misery. So we want to figure out how we can allocate the current misery, which makes me optimistic about the future. On the upside, to think about how to allocate the benefits. And that is things like co-working. That, set aside WeWork, the idea of co-working, the idea of shorter term real-time pricing and leases will become a standard component of office. Every major office building will have some portion of its space as co-working.
And I think that's a great link between the future use of space as we come out of this, as well as our optionality topic, right? So you're talking a lot about, lease optionality, particularly in the workspace, in the co-work space. I read an article, I think it was a couple months ago, that like 35% of tenants in the multifamily space were more interested in short term. And maybe that's just through the pandemic. I don't know. I'd love to hear your thoughts there. But just the thought of optionality and these different, more flexible business models, as well as like fractional ownership, just really just shifting the business models over these last few years. How does that impact in your opinion, NOIs, therefore asset valuations, as we're getting introduced more to these less predictable lease terms, cash flow, and things like that?
One advantage of multifamily is essentially it was a form of short-term, the leases were short dated. They had short durations. They could be adjusted in markets. But the industry faces the fact that in a growing market, it can take 5 years to get a major multifamily project built and leased up. So the basic physics of commercial real estate haven't changed in any of this. Where I think it's more likely than not that we go with multifamily is the potential of short duration leases, but the entity trying to do those short duration leases are going to have to do full stack, right? You're going to have to provide furniture, other sorts of amenities, because it's costly to move.
Yeah.
Right. To pick up, furniture and move it from point A to point B is costly. Time cost, explicit cost. When I think about the idea of moving toward the short duration lease for multifamily, which I think is an interesting prospect, that structure is basically going to have to say you signed a 3-month lease, but you move into a turnkey space, right? Everything is there. And it's all in pricing. You don't pay for heat or cable or anything. It's all in pricing. You have a monthly rent for 3 months and the option to renew. You're in the first player position. That I think could be very interesting in this model, but you will have to basically reflect that they need to be able to walk into a space, feel comfortable, because they're only going to be living there for 3 months.
Mm-hmm.
Right? It's not moving the furniture in week 1 and then moving the furniture out 3 months later. They have to be able to walk into a space in which they feel comfortable, and the cable's turned on. It's a large flat screen TV with a remote. All of it has to be there. And I think that has a potential. That is an interesting investment thesis if you could scale it.
I wonder if that's something that Class A may consider.
It could do.
Yeah, I mean, I guess it's similar to some type of extended Airbnb type model
with much nicer space.
Yeah.
I've only stayed at one Airbnb, and I would not classify it as nice space.
So you think, just to recap on the optionality, you think it's obviously the office leases, they continue to tweak those models, and you'll see more of those different companies get introduced to the market for tenants and things like that, more optionality there, as well as potential extended Airbnb models, but nicer luxury, a place you can truly call home and have a few months at a time with the option to renew.
Right.
Those are the two, in your opinion, asset classes that we'll see a lot of that optionality in?
Yeah, no, I think that's exactly right. And the way to think about this from traditional pricing is not, we used to think about large scale commercial real estate as bond pricing. The monthly rent was a coupon. We approached it from the perspective of bond pricing, and with that, a set of risks, most of which was interest rate oriented. As we move to shorter duration leases, it will look more like equity pricing. So you moving from how you value a bond to how you value an equity is very different. And that will have to come into play.
Interesting.
And we have a test case of this. We call them hotels.
I was going to say, it sounds like underwriting a hotel.
And it gets back to, average daily rates and things like that. So we do have a model already in place in commercial real estate, which is the hotel, and the measures of performance are slightly different, but thinking about valuation from the perspective of a hotel, of an overnight stay, I think is a valuable approach to valuation.
And it sounds like it's somewhere in between from a risk perspective, a risk premium expectation for investors. It now would fall somewhere between the traditional multifamily model and hotels, because naturally people aren't going to do a day and one night and leave, right? So it's somewhere in the middle for modeling as well as risk adjusted returns, it sounds like.
Correct. So it's not the average daily return, but it's the quarterly daily return or something along those lines. And thinking about vacancy from the perspective of quarterly vacancy. And that, I think, COVID accelerates because it forced the industry to recognize, frankly, the value of optionality. If the market can form, then it's just a matter of how, I'll call them loosely, tenant and landlord share in the returns, recognizing that they have to deliver a great product to a tenant. Companies like RXR don't even call, Scott Reckler has banned the use of the word tenant. He calls them clients and talks about client service. The old model of somebody signs a 10-year lease, the tenant, triple net 10-year lease, and the landlord walks away and comes back 9 years, 9 months later. That we've punctured that glass ceiling now, I think. And we will begin to move away from that traditional structure. Investors will need to think about options pricing. And as I say, they will always have to think about data. The role of algorithms in trying to value properties will be critical, because you can't just say, okay, I have a 90% occupancy rate in my building on average, and my rent roll looks like this over 10 years' time. Landlords will have to intervene to try to retain tenants. That's machine learning. They will need to think about hedging strategies. That's machine learning. And so the industry looks like bond trading in the early 70s, where everything was done on a golf course until we got data, and B, we got a way to think about bond pricing or options pricing, and that advanced that industry very rapidly. And equity trading now is largely algorithmic. It's just machines throwing ideas back and forth, or puts and calls back and forth.
So I'd like to shift a little bit, well, still in the same vein, talking about a little bit more about reports. So for our audience who wants to follow the economy, understand, and maybe start forming their own opinions, I'd like to talk about economic reports, and then we'll wrap up with hearing about the work that you're doing in machine learning and data science and how that relates to real estate. But as far as the reports, it's interesting. You said earlier in the show, you talked about the inverted yield curve and how that can project future recessions. And I know in the past we've talked, and the historical indicators, it sounded like maybe that was as of 2019, but it sounded like some of those indicators may not be as relevant, and maybe you can't predict how you used to be able to predict using these indicators like the inverted yield curve. So I just wanted your thoughts on what reports you look at today. Do you look at them differently now that we're dealing with a health crisis and how that's impacted the economy? Or do you still look at the traditional reports that you've always looked at, and just maybe a broader understanding of how which report someone should focus on understanding and how they would tie that into real estate?
I always remain focused on yield curves. Because they remain a gauge, a broad market gauge of expectations about future growth. So the yield curve with liquid markets, so the 10-year minus the 3-month, very, very liquid markets, that remains a critical focus of mine. We don't get high frequency data on labor force participation. It's quarterly, so it's useful if we start seeing some increase in it. And then I essentially look at something called the TIPS, inflation protected securities. It's the 10-year US Treasury minus inflation rate, which is currently negative. So when people say to me, what might happen if the Federal Reserve goes negative with interest rates, I say the real interest rate is negative. The TIPS rate is negative, and so and that's a high frequency number that I pay attention to. These impact real estate, certainly multifamily real estate, in that they do determine rent to buy calculus for individuals. I have a friend who moved to Pittsburgh a couple years ago, bought a house. He's refinanced twice in the 2 years that he's owned that property, because the first round of refi was to reduce the rate. The second round refi was to reduce the term, and he's paying the same amount, and that's a direct implication of COVID and current monetary policy. Anecdotal, completely anecdotal, but for me, yield curve, Treasury, inflation protected securities, TIPS, 2 high frequency measures. And then thinking about the state of labor markets, the thing I find most relevant at the moment is a participation rate.
Awesome. Thank you for that. And Kent, you can wrap it up, in my opinion, with the most interesting question of the day to hear about what Tim's doing in this data science space.
Definitely. Tim, could you close out by summarizing the work you do in the data science and machine learning, and how these newer topics in real estate will play a major role in the industry moving forward?
Yeah, so as I say, I mean, this real estate looks like bond trading in the 70s. Not that I was trading bonds in the 70s, but just a very primitive relationship-oriented business. We have access to many valuable non-traditional data sources currently in commercial real estate. We can move beyond the idea of a submarket to something much more granular. We can move beyond the traditional quarterly numbers that we see on rent and vacancy. So we can do 2 things at once, which is we become more granular geographically, and we increase the time frequency with which we observe things. And that changes the use case. That makes commercial real estate performance look like the Netflix recommender system, which is a completely different algorithm than the traditional algorithms we think about in commercial real estate. Because well, I won't go into that, but people can look it up. So the class of machine learning models we apply to Netflix or commercial real estate is to look for 3 or 4 components that help to explain a great deal of the variability in some outcome, like rent growth or vacancy changes. And that's really what the Netflix recommender system is. On Tuesday, I did my introduction to machine learning class for the data analytics class at Shack. Shameless plug for me now. No other real estate school is doing this. I can assure you of that. Indeed, they're borrowing my materials. But what I did was I basically introduced an idea of thinking about having, if you think about an Excel spreadsheet, you have 50 rows of data and 5 million columns of data. And that's a different structure than we're used to having in commercial real estate. And what you want to do is say, how can I combine those many, many columns of data into 3 elements that determine most of the variability in the rows of data, which is the use case that Netflix faced, because there are 50 movies they might recommend and they observe everything about you. And I believe as we move more granular in real estate, we move more high frequency in real estate through optionality, we will deploy new algorithms like those that are used for the Netflix recommender system. So what I did was I basically taught 2 of the algorithms that are used in that space, which is called unsupervised machine learning.
Unsupervised machine learning. Okay. Okay. So no, I think that's a great point, because it brings up what I talked about, submarket, but I know you hate the word submarket, and you just reminded me when you said that. So prior to the show, we were talking some things that I'm working on, and talked about getting hyper local, but then I accidentally said submarket in front of Tim Savage, which to him, that's not hyper local. And that's a term that should be retired. So I apologize for that. I'm a little rusty. It's been a while since our discussions. No, but
and there are entities. Look, I mean, the industry can turn to these tech startups, in which I will say I have no financial interest at all, but they are the VTSs, the Reonomies of this world, who are basically collecting non-traditional data, aggregating it, and it is much, much more granular and much, much more high frequency. And then when you deploy the algorithms, you can begin to think about outsized rent growth, or the idea of intervening to affect churn, right? If you're going to go to a short duration lease model in multifamily, what you want to do is try to predict your churn rate, the rate with which a given tenant changes. And there may be ways you can say, okay, this tenant, she is in a 3-month lease. In month 2, we send a bouquet of flowers or something like that. But you learn ways in which to intervene to change, to improve the likelihood that the tenant stays, churn reduces, and that flows right down to NOI.
That's super interesting. Now that's like actionable too. So beyond the data and the analysis, you now can take it a step further and apply it to the asset and your performance in your portfolio.
Exactly.
That, folks, is the future of, or it should be, I think, the future of real estate. Depends on how quickly people adopt it, believe in it, understand it, or take the time to understand it. But I think the work that you're doing is phenomenal, and it will continue to have people think about real estate just a lot differently, like I have since hearing your ideas and your concepts. So where can people find you, follow you, read your research and things like that?
You can find me on LinkedIn. Everything I've done in terms of an intellectual undertaking is on my GitHub page, which is just github.com/thsavage. If you want to see what the data analytics course looks like, you can go there. I'm going to be giving a number of talks on the post-election implications for commercial real estate. Unfortunately, I'm going to be the one who's saying it's all local, it's all zoning. Not exciting, but my personal opinion. But easily found. My email address is timothy.savage@nyu.edu. Anyone, feel free to shoot an email to me.
Fascinating. Well, thank you so much. Thank you for your time. Gave us over an hour, so we're so grateful. A brilliant mind in real estate and a great economist. Like I said, I've learned a ton from him. That's, again, Tim Savage, aka the real Savage. You know, whatever. Thank you again, Tim. I'll talk to you soon.
Thanks for having me. Bye-bye.
Right, take care.
Definitely.
Bye-bye.
Thank you.
All right, perfect, man. So for all the folks listening, if you are on YouTube, sorry for the technical difficulties in the beginning. Kent, thanks for the flexibility. Your forearms are probably burning from trying to hold the phone the entire time. But we got through it. If you're on the audio side, you didn't see any of it. So just disregard everything I just said.
I think I need a new arm.
Do you have any final thoughts on sports or the show?
We can just talk. Yeah, we can talk about NFL briefly. A couple of weeks ago, we talked about the who were the contenders and the pretenders, and it looks like the Steelers are the last remaining team that's still undefeated. I think Vegas has them now second in odds behind Kansas City to take the whole thing. So that's two AFC teams that are currently dominating. My Niners are just full of injuries and who knows what we're gonna do. We lost 3 more wide receivers due to COVID, and we play tonight. So I think we have 1 active wide receiver on the roster. So it's gonna be interesting to see who even dresses up.
When this show ends, I'm flying out, and I'm gonna be on the field tonight. So be sure to check me out.
Definitely.
No, I saw the. Go ahead.
I was gonna say I'm gonna put on my Jerry Rice jersey. I'm gonna go show up. So
perfect.
See what
REIT ballers, be sure to watch the Niners game when both of us will be out there and get some stats. No, I saw the Steelers Ravens game, and that was a great game. Even though the Steelers ended up winning. I mean, the Ravens also looked good.
Right.
It was a solid matchup.
Controlled. Yeah. They definitely the Ravens controlled the game for probably 40 out of 48 minutes.
It was a
great their way at the end.
Great matchup. In the end, none of this matters because the Eagles are the sleeper team right now. That's just going to come out and somehow be good all of a sudden and win the Super Bowl this year. So there's that. So none of this is
they
the
are
AFC even matters.
They are currently in first place. So Go Eagles.
Definitely. Yeah.
Good
So
place to be.
the only piece I have for my final words, just if you're interested in our upcoming newsletter, just send us an email, serve, SERVE, at REITball.com. Again, serve at REITball.com. If you just express interest, we're going to be doing a weekly newsletter, and it's going to be tied to the weekly performance that I started recording and launching on the podcast side. So it'll talk about just weekly performance of REITs that we cover. Once a month, it'll also cover year to date of the REITs that we cover. It will talk about a REIT of the week where there's more detail on a specific REIT. Any big like economic news or real estate industry news, and any large transactions like I think there was just a commercial transaction in New York, an office building that just sold for $950+ million, one of the largest transactions since the spring. So things like that, just to keep you current, just by looking at a short newsletter once a week, we'll give you all the highlights so you don't have to look around. Again, if you're interested, serve at REITball.com. And then as soon as we launch, we'll start sending you that newsletter.
Follow,
that's all.
Like, and share.
Follow, like, share.
Like, and share.
Click on notifications if you're on YouTube. Other than that, you all have a great rest of the week and weekend. We will drop another episode next week, so stay tuned there. And thank you for all the support. Make sure you continue to drop comments on YouTube as well. All of that helps us in growing and spreading the word.
Definitely.
Thanks again. Until next time, take care and stay tuned.